Before we take advantage of institutional supply and demand, we need the basics. If you already know them, skip ahead. But most traders who think they know them cannot explain why price moves. Demand is the willingness and ability of buyers to purchase an asset at various price levels. The lower the price of something, the more buyers are willing and able to purchase. The demand curve shows the various quantities buyers will trade at various prices. Buyers always want to buy low. Supply is the opposite. Supply is the willingness and ability of sellers to offer an asset at various price levels. The higher the price, the higher the quantity they are willing and able to offer. Notice that buyers and sellers have conflicting interests. Buyers always want to buy low, sellers always want to sell high. This leads us to the law of supply and demand, which states that price always seeks equilibrium, the point at which the quantity demanded equals the quantity supplied. Graphically, the equilibrium point is where the supply and demand curves intersect, and this represents the current price. It is a point of compromise between buyers and sellers. The market rarely stays at the same price. New information changes the perception of buyers and sellers at all times, and this shifts the balance continuously. Imagine new information makes buyers believe the current price is low. They become willing and able to buy more at the same price, which shifts the demand curve to the right. Price has to go up to find a new equilibrium point along the supply curve. That is effectively how price changes. The same mechanic occurs with the supply curve, and both can shift at once. Chapter 2. Buyers and sellers are always preempting the behavior of one another. If buyers detect an increase in supply, they automatically become willing to buy lower. If sellers detect an increase in demand, they automatically become willing to sell higher. That preemption creates the spread. Preemption creates a spread between the highest price buyers are willing to trade at, the bid, and the lowest price sellers are willing to trade at, the ask. This is where market makers and high-frequency trading firms enter the stage. Their primary goal is to profit from the bid-ask spread by providing liquidity. They quote a slightly higher bid and a slightly lower ask. The higher bid attracts sellers, the lower ask attracts buyers. Liquidity rises, the spread narrows, and the market maker's profit sits inside the spread as compensation for the stabilizing role they play. Notice that market makers also want to buy low and sell high, adhering to the mechanism of supply and demand. They just do it inside the bid-ask spread. High liquidity reduces volatility, which is exactly why the withdrawal of liquidity produces violence. It is useful to think about supply and demand in terms of order flow. Aggressive supply or demand represents the initiation of movements through market orders. Passive supply or demand represents the absorption of movements through limit orders. Market orders always match with limit orders. In the order book, we have 3 columns. The left column is the bid, showing buy limit orders below the current price, passive demand. The right column is the ask, showing sell limit orders above the current price, passive supply. The middle column is price. In blue, we have the spread, a liquidity vacuum created by the constant preemption of buyers and sellers. For price to go up, buyers have to aggressively consume the passive liquidity in the ask column. The lower the available liquidity at each price level, the easier it is for price to consume that level and move on. Low liquidity facilitates price movement. One very important detail, market makers can either facilitate or block the advancement of price. By injecting liquidity, they can block price movement. By removing liquidity, they can facilitate it. Imagine a large hedge fund wants to place a massive long position. Market makers and HFT firms can detect that in the order flow if the fund is not careful. They can remove liquidity, which increases slippage for the fund, or they can anticipate the movement and profit from it if they believe the fund has good information. The battle of liquidity is not just between institutions and retail traders. There are other battles happening between institutions. Institutions all have a gun pointed at each other's head, metaphorically speaking. It is a constant game of anticipation, deception, exploitation, and survival. Chapter 3. There are 2 reasons you should care about institutional supply and demand. First, institutions are responsible for most of the volume in any market. Second, institutions are obligated to act in a certain way because of their size, and that generates patterns retail traders can exploit. In Forex and futures, 90% of what happens on the chart is institutional activity. In US equities, around 70 to 80% of shares are owned by institutions, and it is estimated that more than half the daily trading volume is high-frequency trading firms alone. Instead of being on the losing side of a trade against an institution, you must learn to ride with them. Imagine a big institution wants to execute a long position of 2,000 contracts. The available liquidity in the ask column is not enough to accommodate the whole position at one price level. At $30, only 250 contracts exhaust the available liquidity. The institution still has 1,750 to execute, so it must move to the next level where there are 3,441 contracts. A large position easily consumes liquidity across several price levels, and this draws the attention of other institutions. The first situation is called anticipatory trading, a legal form of front-running. Trading institutions monitor order flow constantly, so anything that deviates from the norm raises red flags. If an institution tries to place a massive long trade, others can assume it has good information. They jump into long positions, which increases slippage for the original institution even more, because now there is more demand and less supply. Drawing attention creates a cascading effect that tilts the balance further. Anticipatory trading can be viewed as a response to, or an exploitation of, the dynamics of adverse selection. Adverse selection is the risk of trading against better-informed participants. When institutions detect unusual or well-informed order flow, they adapt, either avoiding losses or attempting to profit from it. Another thing that can happen is a liquidity vacuum. Market makers and high-frequency algorithms whose primary goal is providing liquidity can withdraw that liquidity to prevent being run over. That also increases slippage, since liquidity dries up and price becomes more volatile. It is also possible both situations happen simultaneously. Some institutions anticipating, some removing liquidity. This leads to a liquidity shock, which translates into a violent price expansion and terrible execution. The necessity of executing large trades is a problem the institutions must address. The solution to avoid liquidity vacuums, anticipatory trading, and slippage is order splitting. An institution that wants to execute a massive trade will split it strategically over time. This leads to a theory of how market phases such as accumulation, distribution, and trends are formed. Imagine an institution wants a large long position. By far the best place to split orders is at the end of a downtrend, in the beginning of an accumulation, because there is still supply left provided by uninformed participants and price is maximally discounted. The institution executes part of the position. As price rises, supply overcomes demand and price falls back toward the bottom of the range, giving a second chance at a discount. The institution can produce minor liquidity traps to the downside to increase capacity. In the Wyckoff method, the end of accumulation is marked by the ultimate liquidity trap, the spring, a move below the range that induces uninformed traders to sell, creating the liquidity smart money needs to go long. Institutions continue to split orders as the trend takes place, especially at the beginning. After partial execution, the market produces an impulse to the upside. As price rises, sellers appear, and when there is enough supply, a pullback begins. The institution still has the sole purpose of going long and executing the rest of that massive position. At the end of a pullback, it has another chance to execute at a discounted price, which in turn triggers the next impulse, and so on. The capacity of institutions to get in at the demand zone is influenced by liquidity inducement. If there are swing lows being triggered as the pullback occurs, the smart money has small bursts of liquidity created by retail sellers to execute its long position in stealth mode. A trend cannot last forever, so institutions need a way out without drawing attention. In the same way they split orders to get in, they split orders to get out. As the uptrend approaches termination, you begin to see signs of institutional supply near the highs, meaning pullbacks start to become engineered rather than a natural consequence of supply increasing. That represents the distribution of the original long position, which is now in massive profit. If an institution is not careful in offloading, the result can be catastrophic. Retail traders believe that institutions only make money, but that is not true. Institutions can and often do lose money quite significantly. If this delicate order-splitting process goes wrong, it will most definitely end in tears. Chapter 4. The market is not made of one institution that uses order splitting. It is made of many, operating in different timeframes with different goals. Order splitting works across multiple scales. But how can we keep track of all of them? The composite operator is a fictional entity that represents the combined actions of large informed market participants, institutional traders, market makers, and other smart money players. Wyckoff's idea was to treat all institutional behavior as if it were one single entity, to make market logic observable and tradable. You may think the composite operator implies the market is run by a centralized entity or algorithm. It is the exact opposite. The composite operator refers to emergent behavior, a phenomenon where complex organized patterns arise from the interaction of simpler elements without any central coordination. Bird flocking looks like a single organism, but no bird is in charge. Each simply reacts to its neighbors. Consciousness is found in no single neuron. It arises from billions interacting. Likewise, the interaction of many trading institutions gives rise to what Wyckoff called the composite operator, the consciousness of the crowd of well-informed participants. It is very important that you realize the unity of the composite operator does not mean there is centralized control in the market. On the contrary, decentralization is an inherent feature of any market. If you think the market is run by a single algorithm, you do not understand complexity, emergent behavior, and the logic behind any market. Chapter 5. Now the practical work. A demand zone is an area where the composite operator executed part of his large long position in the recent past, and therefore it provides an opportunity to execute another part at a discounted price when the market is trending. A supply zone is the mirror image at a premium. There are mainly two types of supply and demand zones: reversal zones and continuation zones. A reversal demand zone follows the format drop, base, rally. A reversal supply zone follows rally, base, drop. The base can sometimes be very subtle or narrow. It is not necessarily a long consolidation. A reversal demand zone follows the format of a drop in price, followed by a base, some kind of small consolidation or momentary stop, and finally an explosive movement out of the base represented by a rally. A reversal supply zone is a rally, a base, and a drop out of it. One important detail: the base can be very subtle or narrow. It is not necessarily a long consolidation. Continuation zones are a little different. A continuation demand zone is formed by a rally, base, rally structure. A continuation supply zone is formed by a drop, base, drop structure. These are the zones the composite operator uses to keep filling an order in the direction of an existing trend. Some traders like to call the boundaries of supply and demand zones proximal and distal lines. In a demand zone, the distal line is on the bottom and the proximal line is on top. In a supply zone, it is the opposite. This nomenclature adds unnecessary confusion. It is perfectly fine to call the boundaries what they are, the upper and lower limits. How you call them is irrelevant. The important thing is knowing how to identify them precisely. To identify supply and demand zones, we follow a simple two-step process. Number 1, identify a significant move. Number 2, identify the base out of which the significant move was born. One characteristic of a significant move is candlesticks with high body percentage. The body occupies most of the candle range. That is a sign of certainty. On the other hand, it is common to find candles with low body percentage in a base. If you are interested in learning more about the geometry of candlesticks, that is a deep subject on its own. For now, high body percentage means certainty and marks the significant move. Low body percentage is common in a base. However, identifying the base out of which a significant move comes is only a rough estimation for a zone. We need more surgical and objective techniques. Chapter 6. There are ways to draw zones based on rough estimation, and ways of drawing zones with extreme accuracy. The more precise a zone is, and the closer to the stop, the better its risk-reward efficiency, which is extremely important. Notice that risk-reward efficiency is non-linear. If we start from the 1:3 ratio and reduce the stop size by 50%, we get a 133% increase in risk-reward ratio, with all else maintained equal. With a 1:7 ratio, You can be wrong for the next 7 trades and still break even. There are 2 classes of technique for drawing zones with striking accuracy: zones based on price action and zones based on order flow. It is also possible to find common ground between them, which often provides very powerful zones. The first technique to identify a supply or demand zone is called the swing point range. It consists of highlighting the whole range of the candle that forms a significant swing high or low. In an uptrend, we look for demand zones. Identify the more significant swing lows, recalling that a swing low is a candle with a higher low to the left and to the right. Highlight the whole range of that candle and extend it to the right. There are variations of this technique. The closer you get to the swing point, the smaller your stop loss and the lower your risk. But at the same time, the closer you get to the swing point, the greater the risk of not getting filled, simply because price might reverse before it reaches you. One of the problems with zones is precisely the fact that they are zones, not lines. There can be hesitation or doubt about when to enter exactly once price is within the zone. One method to solve this is the midpoint line. This increases objectivity by highlighting one price level instead of a range. When a swing high is formed by a relatively wide range candle, highlighting the whole range gives a supply zone that is too wide. The midpoint line mitigates some of that risk and often works with extreme accuracy. Another price action-based technique for drawing accurate zones is to spot areas of fair value at the base that originates the zone. If you recall Steidlmeyer's auction market theory, areas of fair value are ranging and areas of price discovery or unfair value are trending. The idea is to capture the small range at the base, and there is a completely mechanical way of doing this. For a swing point to form, we need 3 candles, and there is usually an overlap between these 3 candles. The fair value reversal zone exists in that overlap. You can also use the midpoint line in alignment with the fair value zone if you want more objectivity. Chapter 7. Order flow refers to the mechanics of how price action is formed. It is what happens behind the curtains of price action. Some people think they can read order flow just by looking at price action, but that is incorrect. We need tools to see what price action cannot tell us. The first order flow technique is similar to the swing point range, but instead of looking at the candle range, we look at the value area in the footprint of the candle that forms the swing point. Access the footprint of that candle, highlight only the value area, and later you can see that price returns exactly to the upper limit of this area. Another very interesting order flow technique to spot where the composite operator splits orders is the stacked imbalance. Stacked imbalances are specific areas in the footprint chart where the balance between supply and demand becomes heavily skewed to one side. These often serve as benchmarks for the composite operator in the future, acting as reference points for potential re-entry or continuation of intent. Right after a swing point, you will often see a large stacked imbalance in the ask, probably an area where the operator split orders. Notice how a stacked imbalance can provide a far more accurate zone than a fair value gap sitting above it. Another order flow technique to identify zones that are not obvious from price action is to plot a volume profile with a 40% value area on the base you are looking for. This works better when the base has a clear consolidation form. Extend the zone highlighted by the value area and you get your demand zone. In this technique, using the midpoint line is equivalent to extending the volume point of control. The third order flow technique is the anchored VWAP. Institutions use the VWAP as a benchmark of execution, meaning that executing trades at or slightly better than the VWAP line serves as a reference for when and where the composite operator should split orders and therefore spark a new impulse. Suppose a pullback ends apparently at a previous base, but price could have stopped in another small base below, or in the more prominent base at the lowest low. One way of deciding which base to trust is the anchored VWAP, usually plotted at the most prominent swing point. Once it is plotted, everything becomes obvious. The pullback ends at the main VWAP line because the operator sees it as a benchmark of execution. Chapter 8. Zone qualifiers are properties that should, in theory, enhance the reliability of supply and demand zones, so you can filter out the low probability ones. I say should theoretically because in real charts you will see high probability zones failing and low probability zones working. That is perfectly normal, Since trading is a game of incomplete information, these are general guidelines that agree with the standard theory, not ironclad rules. The strength with which price departs from the base is an indication of the strength of the composite operator. The stronger the departure, the more likely it is a strong zone. This can appear as a wide range candle or as a stacked imbalance. If a base takes too long to form, it implies no urgency and lack of participation. Zones from longer bases tend to have lower probability. A base with well-defined structure, clear boundaries, orderly price action, a narrow vertical range, tends to have higher probability because order splitting is concentrated in a narrow and orderly space. Freshness, zones never tested before, have a higher probability of holding because the unfilled orders are still intact. Originality, an original zone is created out of a drop or rally, not as a response to a previous base, an initiative move rather than a reactionary one. Location, the position relative to significant levels, the trend and higher timeframe zones. Institutional benchmarking, when price reacts to VWAP from a significant level, the zone that intersects it has a greater chance of holding. In this example, we see a demand zone from a base with short duration and well-defined structure, drawn with the simplest swing point range. A few candles later, the zone is tested. It is no longer fresh. When price comes back, it is unable to hold. The reason goes back to zone freshness and order splitting. When a zone is tested, the composite operator has a chance to split orders, which reduces the number of unfilled orders the next time the zone is tested. Price disrespects the non-fresh zone and goes straight to the more prominent demand zone coming from the lowest low, which is indeed fresh, and it works remarkably well. In the standard application of supply and demand zones, it is important to scan for higher time frame zones that might interact with the zones in your home time frame. A 4-hour zone can greatly influence a zone on the 15-minute time frame. If price responds to a higher time frame supply zone and moves in the direction of a smaller demand zone in your home time frame, the probability of that demand zone working is diminished because there are bigger institutions splitting orders on the supply side. A final detail, not exactly a qualifier but worth knowing. Supply and demand zones have similar qualities to support and resistance lines. That means they also have a switching quality. A demand zone that got violated can turn into a reliable supply zone, and vice versa. So if you got stopped out in a zone, you may have a second chance to make a profitable trade right after. Chapter 9. The process of confirming a zone is straightforward, and it is similar to the way we confirm any other important price level. There are 2 steps. Number 1. Observation of the price reaction when it meets the zone. Price action will show signs the zone is reliable once it encounters it. Things like prominent candle shadows are what you are after. Number 2. The presence of relevant order flow elements to support the price reaction. Stacked imbalances, value areas in the volume profile or the footprint, and the intersection with the anchored VWAP are all ways of confirming a zone with order flow tools. In this first example, we see nested zones where one zone switches and provides a good long opportunity. In red is a swing point range, marking a supply zone. The candle forming the swing point is wide, which translates into a wider zone. The supply zone fails, and there were clues. There is no significant strength in the departure from the base, because the strongest bearish candle is inside the base. Worse, the departure from the supply zone is exactly where a significant demand zone from the past sits. There is a clear hierarchy of power. The green zone sparked the more significant upward move. The supply zone is a minor one. Once the supply zone is invalidated, it turns into a demand zone, and at its upper limit, we find another small base that also serves as demand. That is nesting, and price respects the nested area repeatedly before sparking a new upward move. Here we have a demand zone from a wide-range bullish candle after a gap down. The base structure is very well defined since it is made of just one candle, and base duration is very small, both good qualifiers. However, the zone was tested once, meaning it is no longer fresh, and on the second touch it still worked. This is why you cannot treat qualifiers as hard rules. The zone is relatively wide, so we change the drawing method. Drawing it on the fair value range, the overlap between the three candles forming the swing point. The overlap exists only between the swing candle and the candle on the right, because the candle on the left is separated by a gap. The resulting fair value range dramatically enhances accuracy. The first touch, while fresh, happens to the tick at the upper limit. The second touch happens to the tick at the lower limit. From an order flow perspective, anchoring the VWAP at the swing low shows the first touch reacting to the main VWAP line and the second to the 2 sigma line, both key levels for institutional benchmarking. The main point of this example is that the best zone is not really about this qualifier or that drawing technique. It is about finding the place in the chart where the greatest number of techniques intersect. Here, the fair value range, the stacked imbalance in the ask of the swing candle, 2 sequential high-volume nodes at the proximal line, the anchored VWAP and the liquidity inducement below all converge on a single price. That is the bottom line, not only of supply and demand trading, but of technical analysis as a whole. The best zone is not about this qualifier or that drawing technique. It is about finding the place in the chart where the greatest number of techniques intersect. That is the bottom line, not only of supply and demand trading, but of technical analysis as a whole. Here is the working checklist. Direction and bias from the higher time frame. Locate the significant move and the base. Draw the zone with the tightest defensible technique. Score the qualifiers. Wait for reaction and order flow confirmation. Then execute with a stop beyond the distal limit. Hopefully this gives you a better understanding of institutional supply and demand zones. Zones emerge out of the institution's vulnerability. Their enormous power forces them to leave footprints, and that is exactly where you can thrive. Trade with them, never against them.